Welcome to Yahoo Finance Live. I'm Akiko Fujita alongside Josh Lipton, live at the New York Stock Exchange. Let's get you up to speed on the top headlines we're watching leading up to the closing bell. Instacart shares rallying 40% in their NASDAQ debut. The opening price of $42 a share, lifting its valuation to roughly $14 billion. That's still a far cry from that $39 billion it commanded back in 2021. It is the second big public debut for the NASDAQ in a week after ARM's listing, but many analysts suggest this one is a better barometer of the health of the overall market. This union is not backing down. The UAW sticks to its word that it will up the ante if the big three automakers don't come to the table. Noon Eastern time on Friday emerges as the next deadline in an unprecedented strike that could cost the U.S. economy billions of dollars. And heading to $100 a barrel. It's been up, and away for crude oil. Lately, the global benchmark just shy of November highs as supply curves finally feed through. It's a headache for a Fed trying to get a handle on inflation, and consumers also now feeling the pinch at the pump. Let's begin, as always, though, with the market check. Looking at all three majors right now. Red across the board, though, down slightly here. Investors certainly kind of in a pause pattern here as we see the FOMC meeting starting. That decision expected to come down tomorrow. No change in policy expected here, but the Fed will also offer their economic forecast coming down on Wednesday. Taking a look at where Treasury yields are trading right now ahead of that FOMC decision. We saw the 10-year yield testing the highest levels we've seen since 2007, the 10-year yield right now at 4.36. We are beginning this hour, though, with the biggest story of the day, at least in the markets. Instacart making its big public debut as the first notable venture-backed tech IPO in the U.S. since 2021. The long-awaited IPO, however, potentially leaving many of its later investors with paper losses. Instacart opened at $42 a share, reaching a nearly $14 billion valuation. That is still a sharp contrast from a $39 billion valuation in 2021. Despite the company currently finding itself in a better position as it recently began generating profit, the company's valuation adjustment comes after rising interest rates have led investors to avoid high-risk companies. And Josh, we're talking about this because you have to wonder, a lot of these unicorns that are on the sidelines, they're sort of looking at Instacart to say, well, what's the market appetite right now? We're talking specifically about these paper losses because this is a company that was valued so highly in the private round. $39 billion is what we're talking about. And to put this in context here, T. Rowe Price, just one company that was involved in the funding round on the private side of things. The Wall Street Journal reporting that their growth fund invested $86 million in Instacart back in 2020. The value of that investment now down by more than 40%.
Wow.
When you consider where the shares were listed for the debut.
Yeah, I mean, it's a fascinating wrinkle to the story. So late investors, maybe saddle here with paper losses, they're underwater, and you'd be reading kind of the tone, the language of Kiko out there in Silicon Valley. I thought it was really interesting listening to Byron Dieter, well-known, well-respected venture investor out there with Bessemer, sort of the language he was using out there, saying here, things have changed, and really his friends, his colleagues, private investors, he's saying it's a new reality of a reset valuation world they're going to have to adjust to.
And the question, I guess, for these companies that are waiting on the sidelines, are they willing to come to market at a lower valuation? Is this sort of an acceptance of the higher rate environment where they're going to have to compete in? Interesting enough, Klaviyo is another company that we're watching for the debut there. What they're looking in terms of the pricing range for their IPO is closer to what they commanded in the private funding round, roughly $9 billion. So we sort of don't want to say, look, all these companies that are coming to market are going to come at a lower valuation, but Instacart certainly be seen as an example of what's to come potentially.
Yeah, I think you mentioned the founders of these private companies, and it really is this interesting moment because on the one hand, Akiko, they're looking, they see a stock market that's ripped higher this year. They've got employees that are waiting for a liquidity event. If it's not going to be an acquisition, they're waiting for a public debut. And listen, they're like the rest of us. They've got life costs, right? Mm-hmm. They'd like to buy the house. The kid needs braces. On the other hand, right? On the other hand, though, you bring up a good point. Are they as excited to make a public debut when they know that listing price? It might look a whole lot different than their last funding round.
Well, and the other question is, if they don't look for that exit, what are the other options that are available? We've been hearing a lot from VCs about what's been happening in the private side. It's not like there's a lot of capital that's flowing into late stage rounds on that side as well.
Yeah, no, absolutely. So listen, let's get a beat from an expert on this. With the wait for Instacart's public debut finally over, investors are looking at what lies ahead for the grocery delivery company. Instacart makes its debut on the Nasdaq after achieving profitability, thanks in part to a boost in revenue from advertising. And according to our next guest, Instacart's advertisement structure makes it a standout from other gig economy companies. Here to discuss is Ihar, I'm going to mispronounce this, Ihar Maheño. How'd I do?
Pretty good, Igor Makhanyok. Yeah, you're close. Thank you for having me here.
Yeah, and let me start this with just kind of a broad top-down view of this company, because a lot of folks watching this right now, they know Instacart. They used Instacart. Many of us did during the pandemic, relied on it even. Now in this kind of post-pandemic world, Ihar, what's your view of this company? I mean, do you think they are really set up here for success?
I'm sure they are. So we definitely are continuing this gig economy where Instacart started back in 2012, right? More than 11 years ago, and obviously other gig economy companies are doing very well, including Uber, and Instacart keeps improving. And people need groceries, and people are more and more relying on services to help them in this life, right? So and this concept that quite significant percentage of people want the groceries to be delivered as opposed to go into a physical store, and Instacart keeps improving their efficiency. On the other hand, though, Instacart has all these new revenue models, including advertising, that are obviously doing really well for them, and they became profitable recently.
Ihar, you know, Instacart has been eyeing a public debut for some time. You could argue the fact that they waited a few years, certainly their fundamentals have improved, but at the same time, they face more competition. Josh and I have been talking about somebody like DoorDash, who is kind of eating into what Instacart is doing as well. How do you look at that competition, and what do you think moving forward is going to be the bigger driver for Instacart beyond just grocery delivery?
Interestingly enough, I can also mention that there are a lot of competitors to Instacart that stopped operating or became much less significant over the last couple of years. There were at least 5 or 7 15-minute delivery apps that have been all important in 2021, 2022, and are not there anymore. So from that perspective, actually competition is lower. But also, it's all about increasing market, right? So when Instacart was the only game in town, the grocery delivery was 7, 8 years ago. Way fewer people wanted deliveries of their groceries, right? 2020 introduced a lot of people to this concept, and now, of course, some people came back to buy directly from grocery store, but a lot of people want their groceries delivered. So I think that it's all about the market size, and this market can support multiple players. The question there is, the best players in this market can have high margins, can have high efficiency, and Instacart proved that it can outlive and outdo a lot of the competitors. And the fact that they became profitable and the fact that they IPO popped today are all things in their favor.
And so, ER, we should mention you were also, an investor in this name. I just want to, clarify what you think Instacart's real moat is here. And just to go back to Kiko's point on competition, couldn't big retailers just say, listen, yes, grocery delivery is an interesting business, but couldn't they just do it themselves? Or if they want to work with a third-party vendor, why does it have to be Instacart? I mean, what's special about Instacart? Is it the technology, or is that what it is?
There are several things here, of course, in play. So the partnership that they already have are remote in some sense, right? So all of these partnerships are long-term, and they are built on the relationships. But I think the fact that they know how to work with gig workers is great. Of course, DoorDash and Uber also know how to work with gig workers, but it's also a focus, right? So for DoorDash and Uber Eats, it's all like their second or third business line. While for Instacart has always been perfecting specifically this model. Like, how can we deliver groceries from a store to home, as opposed to restaurant delivery, as opposed to car services in Uber case, and so on. So I think that that focus is really, really important.
Ihar, given that you were an early investor in Instacart, I'm imagining you didn't actually invest in Instacart at the point of the $39 billion valuation at the peak. But number one, I wonder what that value of your investment stands right now, given where the public valuation is for this company. But also, what is the conversation that's happening among VCs in terms of these unicorns that are trying to test the market in this higher rate environment?
Of course, so since I came in a seed round very, very early, right after YC, my investment is significantly up on this, right? And the fact that, some entities and investors invest in 2021 doesn't change the game for early stage investors that ended up being positive on this IPO. What is important is this IPO is another signal to people who are thinking about investing in early stage. That investing in early stage has its merits and it's really, really significant, right? So while there are not, percentage-wise, few companies end up unicorns, few companies end up creating outsized returns, but those that do can really, really make it up for the whole volume, right? So Instacart is obviously in several orders of magnitude stock price right now compared to 10 years ago. And this is how we at Geek Ventures invest too, right? So we invest in new Instacarts right now. We invested in companies which have either early pre-revenue idea or they have early revenue, with the plan that we only look for founders and companies that can be IPO'd or multi-billion-dollar exit in about 5, 7, 10 years from now. And I also want to add that this particular IPO will add liquidity into the system to actually restart this flywheel of VC again.
And ER, final question here. I want to ask you about the CEO of Fiji Simo. Right person for that job, in your opinion?
Absolutely. I worked in Fiji's organization in Facebook, and she has been always really the right person for merging innovation and business sense. So she really knows how to go and make the business decisions right in face of, we want to build a technological company, we want to build a highly innovative company, but it needs to be real. It needs to be profitable. And she did the right business decisions back in Facebook, and she's doing the right decisions here in Instacart. I trust her.
All right, Ihar Mahanyo, thank you so much for your insight and your time. We appreciate it.
Thank you very much. Thank you for having me.
Moving on, it's no secret that mega cap stocks like Apple and Nvidia have dominated the major indices this year, and that's evident when looking at the price action of the equal-weighted S&P 500. Meanwhile, market internals flashing warning signs. Yahoo Finance's Jared Blickery is here with us at the New York Stock Exchange, breaking it all down. Jared.
Hi, Josh. Let's go to the Wi-Fi Interactive. Let's take a look at the normal S&P 500, which is market cap weighted. Actually, it's float weighted, but let's not split hairs here. This is over the last 3 months. To the upside, we have 4,600. To the downside, we got 4,300, which means right in the middle is 4,450, and we are just below that point right here. Now, if we were to calculate the S&P 500 where each stock gets equal weight, it looks a little bit different. And you'll see that we are now hanging out at the bottom end of the range here. And in fact, earlier today, we were on track to have the lowest close since June over here, so about 3 months. Now, why is this important? It just shows that we still have mega cap dominance here. That's very evident from the sector action over the last month. Here we have the S&P 500 sectors, communication services, which is XLC, XLY, which is consumer discretionary, and then tech, which is XLK. All of those are the largest performers. Now, it's nice that we also have energy and financials, the value sectors also outperforming, but in general, we do have a situation where these mega caps are still leading, which means if some of them were to break down, such as Apple, which is threatening to do so, that would mean their influence is all that more important. So we're going to want to keep an eye on some of these big bellwether stocks like Apple, like Tesla, as we finish out the year here. Big surprise. Let me just talk about the VIX real quickly, because as I was discussing yesterday, we're coming off the low of the year, and this happens to be one of the seasons this time of year when we see a spike in the VIX. This cyan line, which I'm highlighting right here, that move up happens each September into the beginning of October, and that's where we're up against right now. It doesn't have to happen, but usually this time of year, we should at least be on the alert for a potential hiccup in the markets, shall we say.
Okay, we'll be on the lookout for that one. Jared Blickery, as always, thanks so much for that. Well,
Thank
let's
you.
take a look at some of the top trending tickers that we are watching today. Shares of cruise liners higher today as Truist Securities upgraded Royal Caribbean Cruises to buy and Carnival to hold, as well as raising their price targets on both. Analyst C. Patrick Scholes points to strong forward-looking trends for 2024 and 2025 and conservative earnings estimates. Josh, the context here I think is kind of important. These are analysts that actually downgraded the sector to neutral in July, saying this is a little too hot.
Yep.
Since then, we have seen a pullback in all major cruise liners. Analysts here saying specifically that the strong bookings that they are seeing, price trends going into 2024, 2025 makes this the right time to get back in the stock right now.
Yeah, and how do you think about that with the storm clouds we constantly talk about for the consumer, though? You know, you think about the rising energy prices, higher borrowing costs, resumption of student loan payments. I mean, there are some clouds, some hurdles coming this way.
Yeah, there are clouds, but what we've seen, at least in travel, right, it
Yep.
is relative strength so far. You look at not just the cruises, but in airlines. You know, we've talked a lot about international travel, how that demand really kept up over the summer. You're right to point out as we go into the fall, is that sort of starting to, sort of pull back a little?
Yep.
It certainly looks like at least the analysts here at Truist saying that, look, we expect this to continue the momentum, at least in the cruises. And so we're going in here
Yeah, it's
because we
interesting.
expect that demand
The
to
labor
continue.
market's sturdy but cooling, so how does that play into it? Interesting. So also, moving on here, shares of CVS slightly in the green this afternoon as Evercore ISI upgraded that stock to outperform from in line and raised the price target on CVS to $83. Analyst Elizabeth Anderson cited the company's improving operational issues and that CVS is supportive of a higher valuation. That 83 Akiko would actually represent, she says, about a 20% jump, including the dividend yield. She likes the greater confidence, she says, in management outlook, valuation. Also some catalysts she gave us December 5th, Investor Day.
Investor Day, something to watch, but CVS recently cut its profit forecast, right? Going into 2024, we're looking
Yep.
at a range of 850 to 870. So, look, they've kept their profit outlook for this year the same, but they've also talked about elevated costs coming through. So some headwinds there, but certainly, this is seen as a big boost to the stock, even in spite of that, an outperform rate.
Yep.
Let's move on here to another stock we've been talking about for over the last week. Another downgrade for Planet Fitness. That stock sliding again today, hitting a 52-week low. Jefferies analyst Randall Konik downgrades the company to hold from buy following the departure of CEO Chris Rondeau and nearly cut his price target for the company in half from $90 to $56 a share. Now, Konik says that amid inflationary pressures and higher interest rate impacting franchise demand, the news of Rondeau's departure is likely to weigh on shares over the next several quarters. Jefferies joins JP Morgan and Cowen to recently downgrading Planet Fitness amid the news. It does feel like, though, Josh, that analysts are kind of in a holding pattern. Look, Chris Rondeau is he was a 30-year veteran of the company. He
Yep.
was the face of Planet Fitness. Fair enough to say things are going to shake up, but we're still in an interim basis. Craig Benson stepping in, but analysts saying, look, let's kind of hold back until we get a permanent CEO in place to judge the direction of company. At the same time, those elevated costs we talk about, certainly not a good sign for the expansion when you're looking at things from a franchisee standpoint.
And you can't, you can understand where analysts are coming for, holding back or taking a breather, for example, because that change in this C-suite certainly surprised a lot on the street with that. That was a big headline.
Really abrupt, right?
Yep, exactly.
Considering where he started at the front desk for the first Planet Fitness location. So he really was kind of the face and represented the brand. And with that sudden departure, it does raise a lot of questions, really reflected in the analyst calls that we've gotten.
Got it. Well, we are just getting started here on Yahoo Finance Live, and coming up, a question of privacy. Google is integrating its AI chatbot into your Gmail so it can easily sift through spam and long messages, but how far into your private information will the bot go? And oil prices hitting 10-month highs today. How high will they go? One analyst breaks it down for us. And home builder hacks. One startup reveals how you can avoid a 7% mortgage rate. All that and more when Yahoo Finance returns.
Let's do a quick check of the markets brought to you by Tasty Trade. We've got about 45 minutes left to go in the trading day. We are seeing red arrows across the board with the Dow down about 158 points, the NASDAQ down 54. Also taking a look at the VIX, we had Jared Blickray earlier talking about this coming off of the low of the year. The fear gauge, as he said, tends to spike this time of year, and we are seeing it up about 2% roughly here at 1426. Well, the strike against the big three car makers entering its fifth day without a deal, still elusive. Yahoo Finance's Pras Subramanian is here with the latest updates. Pras, where do things stand? We're looking now at a Friday deadline. Do we call it a deadline? It's kind of the next marker where the UAWs essentially said we're going to expand our strike.
Yeah, that's right, Akiko. They're talking about how they want to threaten to expand those stand-up strikes that are occurring at individual plants. UAW President Shawn Fain said yesterday in a video address that if substantial progress has not been made by Friday at noon, they will look to have more workers stand up and strike at certain plants. They did not say which plants they're talking about or if they would adjust the current strikes at the three plants you see there right now. So that's still up in the air. But I think for their part, the automakers say, hey, we are negotiating with you, with the union. Stellantis, the latest, to talk about how they've extended an offer over the weekend. They're in talks right now with the UAW, so that's still ongoing. It's not that the automakers are not talking to them. It's just the fact that they haven't made any progress, I guess. So this kind of happens as we started to see some of the spillover effects with the industry. We were seeing some part suppliers like ZF, Germany's ZF, who operates plants in the U.S. They had to lay some workers off. And also U.S. Steel, the big steel maker, had to idle a furnace in Illinois potentially to kind of for risk mitigation purposes.
And Pras, I got to ask you too, politics rearing its head as well. We had former President Donald Trump apparently going to skip the next GOP debate, deliver a speech to union workers in Detroit. How could politics impact the negotiations here, Pras?
Yeah, so Trump said over the weekend that he's going to potentially hold a rally in Michigan with auto workers around the time, they said, of the latest GOP debate. And I think that sort of rankled a lot of Michigan Democrats, Ohio Democrats who say, hey, President Biden, I know you support the unions, but you need to come down here before Trump does and steal all the headlines and sort of get some of these blue collar union workers on his side, because that's sort of the president's base. He needs to kind of shore that up, and there's some pressure on him to actually come and join the picket line. But, as you know, that's unprecedented. It's kind of hard to see a sitting president come there and join the picket line. So I don't think it's going to happen. But, this is the kind of pressure that Biden's in right now with Trump kind of coming online here and trying to siphon away some of these union workers, these hard workers who Trump says are being abandoned by union leadership because China is dominating the EV landscape, and that's where the jobs are kind of headed now.
Yeah, Pras, so interesting. Whether they like it or not, politicians are coming. Thank you, Pras, for that insight. Appreciate it.
Thanks, man.
And switching gears, President Biden is in New York today to address the annual UN summit, and his number one priority to make a continued case to send support to Ukraine.
Russia alone bears responsibility for this war. Russia alone has the power to end this war immediately. And it's Russia alone that stands in the way of peace, because Russia's price for peace is Ukraine's capitulation, Ukraine's territory, and Ukraine's children. Russia believes that the world will grow weary and allow it to brutalize Ukraine without consequence. But I ask you this: if we abandon the core principles of the United States to appease an aggressor, can any member state in this body feel confident that they are protected?
And Volodymyr Zelensky, Ukraine's president, is also at the event in New York. It is the first time he has attended in person since the Russian invasion of his country. But even more strikingly is maybe who is not present at the 78th General Assembly. 4 of the 5 Security Council veto members are absent: China, Russia, France, and Britain, as well as India. Joining us now to dig into this is Steve Clemons, founding editor of Semaphore. So, Steve, let me ask you just to begin, high-level question. What do you think Biden's intentions were when he addressed the UN today? His goals, what were they, and do you think he achieved them?
I think President Biden is continuing to underscore that the invasion of Ukraine by Russia violates every norm that those members of the United Nations stand for. It violates, UN charters about territory. And so it strikes at the heart of the UN. And so Joe Biden is taking his ongoing efforts to, maintain strong support for Ukraine around the world to the United Nations. But he's in part doing it to remind America why it's there. I mean, everything Joe Biden does has two things. One's the world. The other is, a lot of support in the United States is flagging for Ukraine. You're beginning to see that issue become more politicized, some Republican opposition to it. So it was an effort to try to find common cause. Did he achieve that? I'm not sure. As you just pointed out, many world leaders are not at this summit. This UNGA, as we call it, feels a little bit more flat than most. There's a lot of parties going on around the city. There's a lot more social justice, climate justice groups doing things. So it has that sort of festive feel. But the United Nations itself seems a bit tired. So I'm not sure that Joe Biden connected in the way he hoped to.
Yeah, Steve, it does feel like at least this week, the narrative on the climate side feels a little louder. But we are talking about Russia, Ukraine. You just highlighted those key members of the UN Security Council that are not there. What does that say about the muscle the UN currently has in this conflict and how a lot of that has been weakening?
It means that the United Nations muscle in that is sort of non-existent. It's split. We just had a G20 meeting, and a lot of, I think there's sort of meeting exhaustion out there. This was held in India. Modi was there. Of course, President Biden was there. Africa was brought in as a full member. And as you remember, they did a watered down version of a statement out of G20 saying, territory should be respected, but they did not specifically condemn Russia. Russia celebrated that as a victory for itself, even as the United States said it was there. So we've been through this dance a little bit just a week ago. And now in the United Nations, I don't think anything has fundamentally changed since that position. But when you look at the members who aren't here, it's very surprising. And the security, there's a lot of pressure of saying, hey, maybe the Security Council needs to be reformed. Maybe we need countries on it who will actually attend the General Assembly. But I think right now, you saw Zelensky come. It's very important that he is here. He gave a speech basically outlining how Russia has weaponized food and weaponized energy. But it seems to kind of be a lost, in my view, and I hope I'm wrong, it's sort of a lost message here in town today.
And Steve, I did want to ask you about who wasn't there, though, as well, just to emphasize that point. Russia's Putin, not surprising. But what about the absence of China's Xi Jinping? What'd you make of that?
Well, I think it's two things. I think China doesn't want to get caught further in the vice about international responsibility when it comes to territorial integrity, even though it has come out and it has criticized the invasion of Ukraine. It's kind of walked a fine line. But I think at the same time, it sees this moment as America's mess with Russia, and it doesn't want to be tagged in it. At the same time, we all know that China is having a tremendously difficult time with its economy. There's a lot of pressure, a lot of purges going on for alleged corruption and other things around Xi Jinping. He's got his hands full domestically. So I think those two things, both the domestic tumult he has to deal with, and the fact is he doesn't want to get with, if Russia-Ukraine is going to be the focus of big international meetings, Xi Jinping doesn't want to show up.
Steve, even as the president focuses on global events, there is a crisis brewing potentially back at home. We've got the government shutdown looming. We're really going straight up to that October deadline. How optimistic are you that that could be averted? What are you watching in the days ahead?
Well, what I'm watching, basically we've got to watch right around Kevin McCarthy and the signals that the hard right around Kevin McCarthy, Speaker McCarthy, are giving. And these are, it's kind of a mix of never give up, never surrender legislators who feel very, very strongly about their views on budget cuts, on Biden impeachment, on other, dimensions of what they want. And because Republicans have such a thin majority in the House, they have enormous power and they are exerting it. They don't know how long that power is going to last. So I guess what I look for statements from Matt Gaetz, from Marjorie Taylor Greene, and you can tell whether the severity is strong and the spine that they have is strong, or whether they're trying to, find a way to accommodate other perspectives. But I have to tell you, we all discussed this a week ago, and it's gone exactly like I thought it would. We get right up to the brink. But government shutdowns have happened before. And a lot of people are beginning to say if it shuts down, it doesn't do that much damage. It does certainly do damage. And certainly from an economic perspective, it reminds everybody that Fitch's downgrade of the United States in this over its governance issues, it continues to reinforce this apprehension that some have about fiscal responsibility, budget responsibility in the United States.
Yeah, I mean, Steve, you could argue markets, or at least investors, kind of just shrugging, at least going right up to that deadline. So we'll be watching to see if there's any impact on that front, too. Steve Clemons, founding editor of Semaphore. Great to talk to you today. Appreciate the time.
Thank you.
Well, coming up, more legal fights. A new lawsuit filed surrounding Sam Bankman-Fried and his bankrupt FTX crypto exchange. But this time, the target of the lawsuits, Bankman-Fried's parents. Find out what they are accused of next.
Bankrupt crypto exchange FTX suing parents of founder Sam Bankman-Fried. FTX saying Joseph Bankman and Barbara Fried used the company to enrich themselves and their causes. Here with the details is Yahoo Finance's Alexis Keenan. Alexis.
Yeah, this is the bankrupt FTX entity going after Sam Bankman-Fried's parents, Joe Bankman and Barbara Fried, both Stanford law professors. And in this complaint, it says that they either knew or they ignored that certain asset transfers that they received from FTX entities, and there's a variety of them, that they were fraudulent. Now, Bankman is an expert in tax law, and he became an employee of FTX in 2021. And in this complaint, it says he, quote, wielded significant influence at the company. Now, this suit seeks to claw back what is more than $40 million in asset transfers that went either to or for the benefit of the parents and their causes. Now, take a look at some of those transfers. They're from a variety of these FTX entities. Back in January 2022, $10 million in a gift that FTX says was disguised as a loan. That went from Alameda, the associated hedge fund, to Bankman and Fried. Also in February of 2022, a $19 million wire from FTX that went to pay for an oceanfront home in the Bahamas where FTX was headquartered to buy, that was bought by Bankman and Fried. They're the ones who accepted the deed for that property. Later in 2022, $90,000 in expenses for upkeep of that home. Also flowing from November to 2021 all the way till May 2022, you have $5.5 million, a little bit more in donations that went from FTX to Stanford University, where Bankman-Fried's father was employed and still is. In 2021 to 2022, also one more there. Of particular note, this is donations that went to Bankman-Fried's Barbara Fried's political action committee. But the way that the company says that that was accomplished is that the company used an employee who has already pled guilty to charges having to do with FTX's collapse. Nishad Singh, he was supposedly accepting transfers and then pushing them to this PAC that was run and organized by Bankman-Fried's mother. All in all, they say that these two Stanford law professors, very experienced, sophisticated folks, tenured at Stanford University, should have known that the company should not have been making these transfers. They say they did all this. This is just an allegation at this point, all the while knowing that the company was on its way to collapse and on the brink of bankruptcy.
All of this, of course, coming ahead of that big trial for Sam Bankman-Fried in October. Alexis Keenan, thanks so much for that. Well, we are seeing stocks trading lower as we're less than 24 hours out from the Federal Reserve's latest decision on interest rates. Expectations of a pause. Much of investor focus, though, is on what Fed Chair Jerome Powell will say about the November meeting and any new indication on future moves from the updated dot plot. For more on what to expect from the Fed on Wednesday, let's welcome in Vincent Reinhart, Dreyfus and Mellon Chief Economist. We've also got Jim Schmigel, SEI Chief Investment Officer. Good to have both of you on today. Vincent, let's start with you. We're looking at where Treasury yields are trading today, testing the highest levels we've seen since 2007. What does that tell you about what the market expectation is going into tomorrow? What are you looking to hear from the Fed chair?
I think on net, it'll be a somewhat hawkish message. It'll be difficult to deliver. It's wrapped around inaction. Inaction at this meeting was paired with action at the July meeting, consistent with them slowing the pace of tightening. But then they'll use their summary of economic projections to provide guidance for the rest of the year. And they're going to say probably that the appropriate federal funds rate should be a 1/4 point higher by the end of the year, which is a strong signal that they'll be tightening in November. Events allowing, and events are pretty complicated right now, so it's not a done deal. The issue will be whether Chair Powell can sell that message in the press conference. He doesn't really like the summary of economic projections dot plot. He talks about grains and tons of salt by now, and he's probably a little bit more dovish than the median member. So. It's going to be a mixed message.
And Jim, I'm interested to get your take as well about what you expect from the Fed tomorrow. And also, Jim, just listen how you're thinking about the market, where you're seeing investment opportunities.
Sure. For the most part, we agree with Vincent. The Fed does not like to disappoint when the market is kind of all lined up with an expectation like they are for this week, where there will be a pause. The Fed will deliver on that. So we do expect them to take this meeting off. However, we do think there is at the least one more hike baked in the cake. So that will probably come in November. Market projections are, not huge on that, a little bit better than 50-50. We expect them to deliver. And we're not necessarily in the camp that it'll be a one and done situation. We think that a lot of what's happening underneath is, from an economic perspective, is probably still a little bit hotter than what the chairman and the FOMC would like to see. We have a little bit of a turn in some of the inflation numbers, obviously, particularly from a headline perspective, given what's happening in the energy markets. So we do think that the chairman will leave the door open. So we are looking for a bit of a hawkish tone. Has the market exactly priced all that in? We don't think it has. I mean, this is a very interesting situation that we find ourselves in this year, where we have growth type stocks up almost 30%, and the broader market up over 15%. And remember, we have yields up 60 some odd basis points this year. It's fairly unusual to see all of this multiple expansion in the market when real rates are rising. We're a little bit skeptical of that, and therefore we are a bit negative on the market, and we are fading further appreciation from here.
Vincent, we're talking about the FOMC as a whole, but the reality is this is a divided committee. We've heard from the likes of Raphael Bostic as well as Austin Goolsbee, who've talked about the lag factor and how the Fed needs to consider that more. Do you think the economy as it stands right now is strong enough to withstand the lag factors, even if the Fed does hike one more time this year?
Well, look, I think the economy is pretty robust. We're averaging 1/3 workers added to payrolls a month. I think that restrictive Fed policy puts the expansion at risk. We are more vulnerable to adverse shocks. Shocks being government shutdowns, snapback in student loan payments, prolonged strikes. So yeah, we're at risk. I think they went to it with their eyes wide open, because 5 out of 6 times the Fed firm policy on a consistent basis, there have been recessions over the last 40 years. Because they're doing it because they want to get inflation lower. They haven't accomplished the job yet. I think the big surprise for markets isn't a quarter point here or there. The big message the Fed's going to want to convey is they're going to keep policy restrictive for as long as it takes. The funds rate's going to rest at an elevated plateau, and it's going to stay there until they're convinced inflation's on its way down. I think Chair Powell would rather anchor the funds rate on that plateau than fight for another quarter point or so with markets. That's why we think there's, at best, another quarter point hike on the table.
Vincent, you pointed to the resumption of student loan payments as well as a government shutdown as potential shocks. I mean, how significant is that risk that you're looking at in the way that's likely to weigh on the economy?
They're small, but importantly, they are about confidence. The government has gotten good at dysfunction in the Congress over the years and have minimized the effects of a government shutdown on economic activity. Think how many workers are deemed essential nowadays. But it's a disruption. It's also a disruption that is confusing to investors, particularly foreign investors, and it just underscores the rating agencies' distaste for the dysfunction, for our inability to get our fiscal house in order. So government shutdown, not in itself a major disruption, but it's going in the direction of restraining activity. Student loan snapback, 100 million here. It does add up. It will be consequential, and it hits a cohort that's more vulnerable. The question is, if you get a few of them in a row at a time when policy is restrictive, and the balance sheet restrictions that Chair Powell is anticipating continue to build, that's how you get a recession in the next 6 to 9 months.
And Jim, final question to you. You sounded a bit more cautious there on the equity market. Does that mean, Jim, you're more interested in those defensive sectors? Is it staples, utilities? Where do you see opportunity?
At this point, and given the leadership that we've seen thus far in 2023, really driven by the so-called Magnificent Seven, we think even a position in something like an equal weight S&P 500 as opposed to a cap weighting is actually a defensive posture. So I think you could classify our view, which is that we like value right now. We like quality. We're always going to be interested in earnings momentum out of companies as well. But any posture that moves away from cap weighting right now, we think it does have some defensive overtones. That's the area that we think is a little bit more vulnerable. We've seen really some record concentration in the S&P 500 in particular that we haven't seen for quite some time, over 30% in the top 10 names. We think that does come off between now and the end of the year. It's already started. We think it accelerates from here.
Okay, well, a big thanks there to Vincent Reinhard, Dreyfus and Mellon Chief Economist, as well as Jim Schmegel, SEI Chief Investment Officer. And coming up, oil prices rising on supply concerns. Should we expect $100 a barrel? Find out when Yahoo Finance returns.
Google debuting a slew of improvements to its AI chatbot Bard. The update called Bard Extensions are some of the biggest they have rolled out, and it will pull info from apps to find answers to users' questions from their Gmail, YouTube, and Docs. Dan Howley joins us to pick through it all. Connect the dots for us, Dan. How's it all going to work?
That's right, Kiko. The new Bard extensions is coming to the Bard chatbot, and basically what it'll do is allow you to pull up Bard and then ask it questions. Say you got an email from a friend who wanted to book a trip with you, and you want to figure out when the dates were, but you don't want to have to sort through all of your emails. You can instead just ask Bard, what dates did Mike suggest for our trip, and it will pull up those dates from those emails. It'll sort through all of your relevant emails and give you that information. It also will allow you to go and ask what were the most important emails from the day, or summarize my most important emails from the day. And rather than you having to sort through, different promotional mails or, just straight up nonsense that you may otherwise get, it'll pull out the most relevant information that you need and summarize it for you rather quickly. That the same can be said for Google Docs, as well as Google Drive. It'll be able to pull information from those as well. And eventually, Google says you'll be able to, in other apps, will be able to use this outside of just Google's. Right now, in addition to Gmail, Docs, and Drive, you can use YouTube as well as Google Flights and Google Hotels to book hotels and book flights, as well as look up information for different things on YouTube. So that's the extension side of things. They also, thankfully, introduced a new fact check feature, which is called Double Check. And basically, if you try to get a prompt from, or you get a prompt from Bard, it will provide you with the means to click a little G Google logo, and then it'll go through what Bard provided you as an answer and tell you this is either substantiated by Google search or it's not substantiated by Google search. If it is substantiated, it'll be in green. If it's not, it'll be in orange. Any text that's not colored, though, they can't really say whether it's substantiated or not substantiated. So, you got to kind of take that with a grain of salt. But obviously, part of this is Google's way of fighting back against Microsoft's Bing, as well as OpenAI's ChatGPT, which Microsoft has also invested heavily in. So it's Google's way of really trying to push its Bard forward and really try to get the most out of it so that people recognize it as the leader in AI and not its rivals.
Dan Howley, thank you as always for that insight, sir. We appreciate it. Moving on, oil prices hitting a 10-month high today. Crude trading well above $90. Brent trading at 94, inching closer to that $100 a barrel mark. The price moves coming amid mounting concern over supply stemming from production cuts out of Saudi Arabia. For more on the move and the policies behind it, we turn now to Andrew Lipow of Lipow Oil Associates President. Andrew, maybe just to start, when we see this move in oil, what is driving that, Andrew? Is it a demand story? It's supply? Is it Saudis curbing production to boost the price? What do you see as the tailwinds here?
Well, thank you very much for having me, Josh. The big picture is since last October, OPEC Plus has cut their production quotas by over 5 million barrels a day. And that, of course, has been led by Saudi Arabia and Russia, who've instituted their own voluntary production cuts through the end of this year. This is happening at the same time that world oil demand hit a record back in June, but OPEC themselves are forecasting pretty robust demand growth of 2.4 million barrels a day here in 2023 and another 2.2 million barrels a day in 2024. So the big picture is really one of supply concerns as we look around and we see that world inventories continue to decline.
So you're talking about oil demands, sort of the supply being cut at a time when at least OPEC is looking at demand going up. When you look at that cut that you mentioned, 5 million barrels a day, does that make sense? Is that consistent with where demand is right now, in your view?
Well, of course, they announced a very big production cut from a very high level of quotas. But in reality, they've only cut about 2.8 million barrels a day. But the fact is, we can see the impact of these production cuts in the inventories around the world, as well as in the market structure. And as a result, you're seeing crude oil prices rallying, especially over the last couple of months, for WTI, $92 a barrel, and Brent today hit over $95 a barrel.
Andy, there's of course a backdrop to all of this, which is, you look at the Saudis, sort of leading OPEC Plus here. They are in a moment of transition from oil away to larger investments. At the same time, we have heard the IEA say, look, peak demand is going to come in 2030, sort of earlier than expected. When you look at where the Saudis want the price to be, what is the pain point?
Well, I think for the Saudis, of course, they want higher prices so that they can increase revenue to satisfy their domestic budget spending. And I think that they're more than happy to see Brent prices over $90 a barrel and perhaps let it drift up to $100 a barrel. The Saudis' greatest fear is that the market gets ahead of them and bids up the price to $110 or $120 a barrel, bringing the world into a recession and a consequent significant decline in demand, and then they see their revenues plummet like we've seen in the past.
Andrew, I'm interested to get your take on China as well. Listen, the world's second largest economy, it's weak right now, but you saw some recent economic activity, maybe showing some signs of perking up. How does China play into your thesis, Andrew, of where oil is now, where the price is headed in the near to intermediate term here?
Well, since China has reopened their economy, the oil market has been disappointed at the rate of growth of oil demand that we expected to see over there. But the fact is, in August, Chinese refineries processed a record amount of over 15 million barrels a day of crude. So that was the good news. I think the bad news is that we saw the Chinese government increase the amount of refined product exports. And specifically, we're seeing more diesel coming out of China, which is indicative of an industrial slowdown, especially on the construction side.
Andrew, really quickly here, what options does the Biden administration have as they see oil prices climb? You're looking at strategic petroleum reserves at their lowest level since the 1980s.
They have very few options. They could release more oil out of the SPR. They've already released about 280 million barrels since Biden came into power in January of 2021. But what the oil industry and especially the producers want is a steady policy so they can make their plans over a long period of time to drill throughout the U.S., including in the Gulf of Mexico. And recently, the Biden administration reduced the amount of acreage available in the upcoming Gulf of Mexico lease sale.
Andrew Lipow, as always, good to get your insight. I appreciate you joining the show today. Well, coming up, the closing bell on Wall Street, we are checking in on the latest market moves and the top trending tickers. Stay tuned. back to Yahoo Finance Live. There you have it, a very loud New York Stock Exchange here at the closing bell on Wall Street. Let's do a quick check of the markets. At the end of the trading day here, we've got the Dow down 106 points, the S&P 500 down 9, and the Nasdaq down 32. With the markets check here sponsored by Tasty Trade. We've been watching the Treasury yields really closely today ahead of that FOMC decision, with the 10-year yield today reaching the highest level we have seen since 2007. But let's do a check. You hear that chanting, Josh?
Yeah.
Chanting.
No, really? I thought it was kind of subtle. I wasn't really picking it up.
It's the joy of broadcasting live from the New York Stock Exchange. All right, let's do a check of some of today's top trending tickers here. Instacart is the story of the day, closing the day at $34 a share. That is up about 14% after the stock began trading Tuesday afternoon, opening at $42 a share on the Nasdaq. Certainly a strong debut that was a lot of investors really hoping for. It was interesting to have that conversation with one of Instacart's early investors today. Obviously, he got in at a good price point for the company, but even despite the strong debut, there's a lot of VCs out there that are looking at paper losses because it still didn't match that valuation of $39 billion in the private funding round.
Yeah, and the interesting part of Instacart too, Akiko, we were talking about how it was kind of a test of what were investors kind of emphasizing and valuing. Was it profit or growth? Because listen, Instacart, decent bottom line, but growth slowing. And Instacart will say, hey, listen, that's tough comps, that's inflation. But we know some analysts also saying maybe it's also competition creeping in because there's a lot of it for this name.
Yeah, we were showing that earlier. You know, it's not just about DoorDash, it's Uber Eats, many other delivery services that are out there getting into groceries, although the Instacart argument would be we're not just a grocery delivery service anymore. We have really expanded beyond that since the height of the pandemic when everybody was getting in on Instacart for those deliveries.
Yep, absolutely. We're moving on. Shares of AutoZone finishing the day in the red. The company reported a beat on the top and bottom line during the fourth quarter. Despite being the street's expectations, shares are following on the company's lower than expected growth in its domestic commercial business. This one was interesting, Akiko, because auto supplier, so reports, beats top and bottom. And we had some analysts on Yahoo Finance this morning who were saying, listen, overall, they thought the business looking healthy, but some signs of disappointment thought in the commercial side.
Yeah, it is about the domestic commercial sales coming up short. That's been behind the shares that we have seen moving today. Also, though, interesting to note that there's been some calls out there looking at the impact the UAW strike may have on AutoZone. That's sort of seen as a potential boost to the company. Replacement vehicles potentially being delayed as well with AutoZone and their parts. That could be a big beneficiary, but something to watch for in that stock. Shares of Rocket Lab sliding today after the satellite delivery company's latest rocket malfunction. Rocket Lab reported on Thursday that its Electron rocket failed following a successful liftoff from its New Zealand launch pad. Rocket Lab noted the Electron had previously delivered 171 satellites on 37 orbital missions, that its next flight, currently scheduled for the end of the quarter, will be postponed and revised. Third quarter revenue guidance in the coming days. You know, we sort of call Rocket Lab a satellite delivery company, but they really are looking to expand beyond that to compete heavily with SpaceX. This is a huge setback for the company. We saw the stock moving back in a big way here, and now that third quarter launch, at least, sort of on hold as they really look to see what was behind that failed launch today.
You know, you live in LA, so I turned to you on all things Hollywood. And now after that fantastic documentary on the moon, I just turned to you on all things rocket and space.
Yeah, you're right. I mean, this is a company that's based in Long Beach, just outside of LA. But really, they have really been riding a lot of this momentum at a time when sort of investors have been laser focused on SpaceX. Yes, they have a massive lead, but Rocket Lab really sort of gaining on that. So, you know, that probably reflects even more what we saw today, why investors have pulled back. Certainly a big setback, but more to come.
Interesting. Well, over the next few weeks, Yahoo Finance is taking a closer look at the Magnificent Seven and what investors should keep in mind with the biggest names in tech. Today, the focus turns to Microsoft, from ChatGPT to Azure. There is plenty to talk about when it comes to this tech giant. Let's bring in Yahoo Finance's Ali Garfinkel for more. Ali.
Josh, after years of being thought of as a bit long in the tooth, maybe, Microsoft is back. That is what I'm hearing from analysts on the record, off the record, everywhere in between. And you might think that it's all about AI, but actually it's bigger than AI. What it really goes back to is CEO Satya Nadella's tenure. Over the course of that tenure, now the better part of a decade, he's really been helping recreate Microsoft into a company that's less insular and has its hands in all sorts of piles, right? It's not just software anymore, it's cloud, it's cybersecurity, it's gaming, it's AI. In short, the investments of the last decade are really starting to pay off. We've sort of seen that today, Microsoft announcing its 14th consecutive quarterly dividend. But I actually want to give you a metaphor here, something that an analyst said to me. What he said was this: Microsoft is now an aircraft carrier, a giant aircraft carrier. And the thing about a giant aircraft carrier is that while it's hard to maneuver, it's hard to turn around, it's also hard to stop once it's really barreling forward.
And Allie, some investors, when they hear, hey, listen, everybody on the street is on the same side, everyone's bowled up, that gets them a little nervous. When you think about Microsoft, all these advantages, all these benefits, what are some of the risks you think, though, investors also have to keep in mind?
There are certainly a lot of risks, Josh. One of the things to consider is AI itself is a risk. Nature of tech itself is risk. Again, Microsoft is this giant aircraft carrier that can really turn around very slowly. So if they have to change course, it's going to be tough. That said, I'm always a little bit risk averse, and I'm always thinking about valuation. And what I'm hearing from the street is Microsoft is actually not at the top of its valuation just yet. A few years ago, they were trading at around 35 times. Now it's closer to 29, 30. And analyst recommendations, you're right. Across the board, almost everyone is saying buy. 54 buys, 6 holds, 1 sell. Ultimately, what I would say here is what happens next for them, and probably for you, is if you really believed in this AI-fueled growth theory. Do you believe they're going to be able to use AI to drive cloud, to drive gaming, to really drive wins in cybersecurity and software? If you believe that, if the answer to those questions is yes, then Microsoft has room to run. If not, well, then you're having a different conversation.
Allie, I love it, breaking down the entire bull-bear debate on Microsoft. Thank you so much. And Disney will nearly double its investment into its theme parks and cruises over the next decade. The company saying it now plans on investing approximately $60 billion in the business. Theme parks have shown signs of growth at Disney, while its streaming business continues to slow. Shares not loving the news, closing the day in the red. For more, let's bring in Jamie Lumley, Third Bridge Group sector analyst. Jamie, so investors, they saw this headline, they weren't impressed. What did you think about this news?
So there's definitely a lot to unpack in today's news, and thanks for having me on today. I think what we have been hearing over the last year about Disney is just how much this company is in a period of transition. And if you look at the major headlines over the past few months, you can definitely see that. The streaming business is still not profitable. The linear business is under a lot of pressure. The parks, while seeing some strong international growth, are also not seeing the same foot traffic in the US. And there are a number of concerns about the effect that price hikes have had. So if we look at what Disney is doing today, it's exploring some major transformation initiatives in the linear business, potential asset sales for ABC, strategic partnerships for ESPN, and for the parks business. Bob Iger is really thinking about right now, how do we improve this? How do we strengthen this? Yes, the prices have been going up, but if consumers start to see more value in the parks business, in these experiences, can this be an even bigger growth driver for the company going forward?
Yeah, Jamie, how do we see the two? How do we connect the two here? I mean, you're talking about streaming, the losses there. As you point out, there's a lot to be hashed out in terms of a shakedown on the assets Disney owns. The announcement we got today, is that a result of that, seeing the losses on that side, saying, look, our parks business, even if it's slowing down, has been the big revenue driver. Let's double down on that.
So if we look at these different business units, I think the overall uncertainty on really whether or not streaming and the traditional linear ecosystem can be in this transition to be successful and eventually be a big profit driver for the company, the significance in that uncertainty is making management think, okay, we know that the parks business has historically been profitable, it's still profitable. Parks and experiences are driving twice as much operating income as the entertainment division, even though the revenue totals are quite different. Looking at bolstering up that business while there's all that uncertainty is probably top of mind. So we think about looking over at streaming, while there is a lot of excitement about what this can be, we've been hearing from experts that the profitability target of 2024 might not be realistic. It might take another 12 to 18 months beyond that to really see it become profitable. So really bolstering this other side could bring some stability and balance in this business, which is seeing a lot of different pieces moving. And they're trying to find what is the new strategy to have the traditional Disney flywheel of creating best-in-class content, of content for the family, and then having it be engaged with on a variety of different platforms to ultimately drive success for the business.
And Jamie, speaking of some moving parts here and maybe some big moves coming, and I think you were actually hinting at this before. We've seen these reports, at least, that Disney's been talking to Nexstar about selling ABC and the local affiliates there. I'm just wondering what you make of that news. Does that make strategically sense to you if Disney went ahead and pulled the trigger on that?
It's a really interesting question, and I think all eyes are on what's next in that story. There were the reports about Disney talking with Nexstar. There's also Byron Allen putting in a bid of $10 billion for ABC and some other assets. And really it comes down to how core is broadcast for Disney going forward. And from what we've heard, from what Bob Iger has said in the reports, there's still uncertainty within the organization about how central this can be, because there are a couple major dynamics here. On the one hand, cord cutting continues. Streaming is taking up an increasing amount of time spent engaging with entertainment at home, but there's still a lot of advertising dollars. There's still a lot of opportunity in big things like live sports. ABC and ESPN will be carrying 2 Super Bowls in the next decade or so, and that's a major opportunity. So whether or not Disney wants to fully divest itself from that side, there's still a lot of uncertainty there. And the price tag might be a big factor here, but it is also more strategic about how much can they continue to straddle the line in building out their streaming business, having this traditional cash cow of a linear business as well, or does it really need to start making more bold strategic moves here to actually see the growth and profitability they need within the segment?
Jamie, finally, you could argue that the relative resilience, even though we've seen the pullback in parks recently, has been pretty impressive for Disney, but we're looking at an admission price, inching closer to that $200 mark. I wonder what you think the limit is, despite the loyalty that's been baked in.
Definitely a good question. And if you look at overall the numbers this summer, it seems a lot of people thought that that's really starting to push the boundaries of what's not only affordable, but also what they're really willing to pay for an experience like this. One thing to keep in mind is that while Disney was seeing reduced traffic, other competitors such as Universal was also in a same boat. So there could be a little bit around just overall macro trends and where consumers are spending their dollars for entertainment. But as Disney looks at this, they've had the price hikes, they've had that initial shock. The calculus here could be if right now there is that base which is still willing to pay for it. And if they start to see, though, the $60 billion being put into this business, really adding value to that experience, there could be some increase in the willing to pay. That being said, $200 for a pass is a lot of money. And when people are looking at what that can do in terms of other entertainment options, that could be something definitely weighing on their minds.
And Jamie, I want to end here on kind of a fun one. There's always talk of Apple, Jamie, this sort of undercurrent, the rumors out there. Maybe Apple makes a play for Disney. And, on the one hand, listen, these two have a long history together. On the other hand, that is not typically how Apple rolls. They don't do the big splashy acquisitions. I think still the biggest one they have ever done is $3 billion for Beats. Any credibility put on those rumors at all, Jamie? Could that ever happen, in your opinion? Apple makes a real play?
Well, if we look at the history of mergers, you can never say never, but there are a couple of things we've been hearing. One is, as you highlighted, Apple has historically shied away from big acquisitions. And specifically, if we look at their content business and the building out of Apple TV, they have really focused on developing, from a content perspective, everything in-house. They want Apple-owned content. They want to have those originals be central to that business. And that has been a benefit in terms of exclusivity and driving people to the platform. Also a risk, though, because if we look at right now with the ongoing actors and writers strike, there's no new content or library content to lean on and no new content coming out. So if we think about what value could there be in this Disney-Apple tie-up, of course, there's historically the ties between the company, the relationships at the executive level, but given the scale, current antitrust environment, there are a lot of hurdles to overcome in order to see that sort of deal actually come to be.
Jamie Lumley with the insight there on Disney. A lot of moving parts within that company. I appreciate the time.
Thank you.
Well, coming up, retailers are struggling to hire for the holidays. We're going to break down what it means as the holiday season approaches. That's coming up on the other side.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement. What happens now?
Now, I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Amazon announcing it's hiring 250,000 employees throughout the U.S. Out of those positions, 30,000 will be across California for seasonal workers. However, according to a recent report by Challenger Gray and Christmas, it might not be a very jolly holiday season for retail hiring. Amid a cooling labor market, holiday hiring is estimated to be the lowest since the financial crisis. Firms in the sector are only expected to add 410,000 positions in the fourth quarter. So where does this leave retailers as the holiday season approaches? Here to discuss, we have Challenger Gray and Christmas Senior Vice President Andy Challenger. So Andy, not very jolly. What are the reasons for that?
Yeah, we are expecting the retail sector to just hire fewer people than we have the past few years. Part of that is an overall trend. We've saw kind of peak hiring in the retail sector in 2016, and it's been slowly coming down since then, although we saw a spike during COVID. And then we're also expecting the slowing inflation is going to make it difficult for employers to pass on the extra costs of employees on to consumers in the form of increased prices. And it's going to put some crunch on the labor piece of the equation for these companies.
Yeah, Andrew, let's kind of separate the big retailers that we've been looking at. You know, we talked about Amazon hiring up. Amazon, Walmart, the big box names, so to speak, are kind of the ones where we see the ramp up happen. How do the numbers there you're anticipating compare to years past?
Yeah, we are expecting it to be lower this year. Last year, we saw it drop down to about 500,000 jobs added in the holiday hiring spree at the end of the year. That was down significantly from 2001 and to 2020 when we were in the midst of a real labor shortage in the sector. While there has been tightness that's persisted there, we really saw employers didn't need quite as many people last year in a surprising way. And then this year, amid just generally cooling labor market now for a number of months, we expect that to fall even further.
And so, Andrew, so pinning some of this on, I guess, it sounds like the cooling labor market. Also, how much does this really come down to higher interest rates as well? How much did that play into this, do you think?
Yeah, I really think that is part of it. When I talk to HR leaders, when I talk to companies, they are feeling the crunch in the people part of the equation of their companies right now. Labor costs have gotten much higher over the last few years. We've been in a real labor shortage. Companies hired at a very quick pace for a period of time, but the labor market has continued to cool in step with a cooling overall economy. We've seen month after month of that now, and while we think it has slowed, the cooling slowed a little bit the last 2 or 3 months, we do expect it to pick back up as companies come to this conclusion that they're not going to be able to pass on all of those extra labor costs to consumers in increased prices.
So what's the outlook going into what is typically the busiest shopping season of the year?
Yeah, there's still going to be hiring that's happening. 400,000 jobs isn't nothing. And this announcement from Amazon was a big surprise to the upside. Since we put out this report last year, they had only announced 150,000 people they were trying to hire. So 250,000 is a big increase. There are certainly going to be players there are hiring to their payrolls during the holiday season that need extra help. Retailers will certainly be doing some extra hiring, but we're not hearing quite the scramble that we heard the last 3 years with companies offering no interview positions, hearing back from applications within 30 minutes because it was so competitive. That atmosphere seems to have cooled this season.
All right. Not very jolly. Andrew Challenger, we thank you for your time, sir.
Thanks for having me.
Moving on, mergers and acquisitions in the healthcare space is a target for the Federal Trade Commission, its chair has said. In an event in Chicago Monday, Lina Khan outlined how data the FTC has been analyzing showed below-the-radar deals worth millions over time has created monopolies. Yahoo's Angelique Khemlani was at the event. What can you tell us?
That's right. We all know that, of course, the FTC released some guidelines, proposed guidelines earlier this year, and that came to an end in terms of public comments on Monday, the same day that FTC Chair Lina Khan was talking about just what prompted that change. We know that, of course, the agency has been looking at breaking up monopolies, or at least challenging some of these acquisitions we saw earlier this year. Of course, the Amgen and Horizon Therapeutics deal, which did get to finally go through and is slated to close later this year. But at the event, talking about the DOJ and FTC looking at how they're going to start scrutinizing mergers, FTC Chair Khan said, quote, "We've seen a whole lot of deals that are below our radar, that are kind of slowly and incrementally consolidating a market. And then 5 years in, 10 years in, you have 2 to 3 players that have come to dominate." And that below the radar deal she's referring to is those that are under $100 million. And that's because both the agencies do not have to get notified of every single deal that comes through. And so in these proposal forms that the companies have to file, they're going to start looking at collecting data on what these past deals have been for the merging companies, whether or not that includes some of these below radar deals, and start to collect and accumulate more data that tells the tale. Retrospective studies have shown that, in fact, these are the kinds of deals that have been causing what we see as current day, larger firms' monopolies. And of course, that has been, largely hospitals and major deals in the healthcare space. But this goes beyond that. Now with other players like the tech industry also involved in healthcare, it's going to be sort of opening the door for greater scrutiny of these deals.
Okay, something we'll be watching closely there. Angelique Khemlani, as always, thanks so much for that. Let's do a quick check of the market, sponsored by Tasty Trade. A down day across the board. The Dow down 106 points, the S&P 500 down 9, and the Nasdaq down 32. Of course, we are going to be watching to tomorrow's action with that FOMC decision coming down at 2 p.m. Eastern. Certainly, investors are going to be looking for any language from the Fed on the path forward, although no real policy change expected tomorrow. Well, coming up, we're going to go around the horn with some of the top stories of the day. That is coming up on the other side. We'll be right back.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm Brooke DePalma alongside Josh Schaefer and Pras Subramanian. We're taking a closer look at 3 of the top trending stories. I'm taking a closer look at shares of Starbucks today after the coffee giant is now facing a lawsuit. Now, this lawsuit claims that consumers everyone's claiming here, that several of the coffee giant's refreshers are not containing one ingredient, and that is fruit. As you can see here, these strawberry acai refreshers have become largely popular as their cold business continues to bulk up, with the majority of U.S. sales coming from colds. Now these consumers claiming that in Starbucks mango dragon fruit, mango dragon fruit lemonade, pineapple passion fruit lemonade, strawberry acai, and strawberry acai lemonade, they were missing the fruit. Now Starbucks did tell Yahoo Finance that the allegations in the complaint are inaccurate and without merit, and we look forward to defending ourselves against these claims. Now, this is not something that's new to the food business. We've seen this happen many times before, with consumers sort of saying, hey, wait a second, this looks smaller, this is missing something in particular.
And this is just those people that probably buy a lot of these products and wait to find a mistake, right? That's how I always sort of read these. Who's the burger chain? Was it Wendy's or?
With where's the beef?
Yeah. It's just like, you feel like, is there a chance maybe there wasn't fruit in some of these drinks? Sure. Starbucks is a busy place.
Right.
There's actually maybe a legitimate chance that there was no fruit or not enough fruit, or that's kind of how the service industry works, I think, from a consumer standpoint. If you're going all the time and you're not getting what you want, maybe go to a different restaurant. I don't really sometimes I feel like some of this gets a little bit blown out of proportion, I guess.
So, I mean, I guess we're kind of echoing the thing, like shocker, Starbucks doesn't put real fruit in their drinks, right? But I guess the difference is that mango, acai, dragon fruit, whatever, had no dragon fruit or acai in it, right? So, the judge said, quote, that he rejected dismissal of the court of the case before when a trial, saying a significant portion of reasonable consumers would expect their drinks to contain the fruit mentioned in their names.
Right.
So I think that's true, but I think we're also in that point, like, I buy Fruit Loops. Am I going to get fruit in the Fruit Loops? I mean,
how far can this go?
We know there's like this whole, like, what's the flavor like as opposed to what's really in it. So they didn't say 100% dragon fruit, did they? So I see this going either way.
And those refreshers are pretty good, let's be honest. But do you...
The dried fruit in them?
Yeah, but do you buy them for the dried fruit? No, you buy it because it tastes like dragon fruit or something like, or passion fruit or whatever it is. I don't even want the fruit.
I think you made a good point about how the cold beverage business is huge for them. So this is kind of a problem, right?
Yeah, and also too, I was speaking to our legal reporter, Alexis Keaton, about this, and she said that maybe here they could have a real case. If they say that there's fruit within the beverage, or they advertise it as a strawberry acai beverage, there was no fruit.
Right?
Maybe there is a case
like strawberry, but not dragon fruit.
And Alexis also got into other lawsuits that Starbucks has found themselves in years ago. She was telling me that they used a coloring from a beetle, and so that's what made their strawberry frappuccinos red and pink, right? And it was FDA approved and legal to use, but that also got into a bit of a taboo with the people who necessarily were vegans or perhaps obviously did not want this coloring.
Brooke, you know my easy solution here.
Oh,
What's my Starbucks drink?
black coffee.
If you just drink black coffee, you won't have this problem. That's my
I will
advice.
admit that. I love a good strawberry acai.
Yeah, even
not
ice.
even ice.
You
You
can,
only
no,
do
you can
hot.
put it on ice. That's fine. Then you're going to get ice and black coffee. Nothing will be mixed up.
Oh my goodness.
Simple solution. Simple solution. All right, guys. My story today is Amazon. I have my eyes on Amazon after they announced how many workers they're planning to hire for the holiday season. So Amazon coming out and saying they plan to hire 250,000 workers. 30 of those seasonal in just California alone. That's up 67% from what they've hired in years past. So obviously Amazon expecting a big holiday season here. Target also out saying that they expect to hire 100,000 employees. Macy's saying it will hire 38,000 more employees. Obviously the holiday season just such a big time for these retailers. And it seems though the picture's a little bit mixed on what people expect for holiday sales, but not necessarily at a company like Amazon. I think Amazon has solidified themselves for the holiday season. No matter what, they're going to get some demand.
Yeah, there's lots of takes from Wall Street on whether or not we're going to see an increase in consumer spending or rather a decrease. And one expert that I spoke to said we'll see sort of a normalization returning to pre-pandemic levels after we saw such an uptick in sales last year, largely due to inflation that caused those sales to rise. But in addition to that, as you can see here, these companies are largely bulking up. We heard from Target today that they plan to hire this holiday season. Amazon also ramping up its hiring this holiday season, but definitely mixed picture on how much exactly consumers are going to spend given all these headwinds that they're up against.
I'm kind of surprised the sheer kind of numbers, right? Is it 100,000 more workers this year compared to last year, which is sort of a crazy amount. Expecting fewer shoppers or fewer online shopping to happen, but still a big year. Boosting wages, which is good to see. And I think is it sort of addressing the need that they need more workers, or is it there's been some unionization efforts at their warehouses, and this is sort of trying to say, okay, we'll give you guys a little bit here, just don't go crazy with the unionization at our warehouses, because that's a problem for them.
The boosting wages is interesting too, right? Yeah. To try and get people that are these seasonal workers, like how do you win that worker? I feel like we're still talking about this economy-wide right now, with the worker being someone that is still kind of feeling things out and is high in demand for the amount of job openings that we have. You do have to bump up that pay if you are Amazon, or we were talking about yesterday about Meta. Part of that story with Meta, right, is that they want to retain employees. That's why some of the benefits are coming back. You're seeing companies realizing, we probably do need to boost wages, or we need to give these workers something, especially if they're going to be seasonal workers, right? If they're only coming in for a short period of time, you got to find a way to win them over compared to someone like Target.
Right.
That's probably the same kind of worker we're talking about here.
Yeah.
Right, and something that I've been covering a lot is Walmart sort of now having this power over that potential worker, whereas we used to see it vice versa, that worker having that ability, choosing where they want to go, but now Walmart sort of backtracking entry-level positions would now ultimately be all the same pay. They say it's for more opportunity. Others, experts out there, saying that they now have power over how much exactly they could pay, and that maybe they could pull back a little bit on how much they're willing to pay and still get that opportunity. But we're seeing Target, Walmart, as well as Amazon ultimately start the holiday shopping season even earlier with tons of deals out in October, which is wild.
Yeah, we're going to see winter holiday hiring in July. Is that what's going to happen?
Oh my gosh.
I always think about that movie when we talk about Amazon workers, that movie where Frances McDormand was living in that van. What's it called? Nomadland.
Okay.
Nomadland. Awesome movie. Check it out. Great stuff.
So far above my head.
You'll enjoy it. It's really good book too. All right. So earlier today, just switching gears, changing propellers.
Potential holiday gift, Pross. Potential holiday gift.
God.
Big holiday.
For us, maybe.
See, this is why you're the good.
Potential holiday gift. I'll be buying one for myself.
Segue man.
Will you? Yes. Wait till you hear the price point.
Former producer, this guy. So I was at the Brunswick's Media Day today. Brunswick, the biggest recreational boat maker in America. They had their media day today in Chelsea Piers Marina here in New York City. Saw some big boats. We rode some boats, talked to the CEO.
Yachts.
But one of the things that caught my eye was a thing called an e-foil. It's a thing that basically is like a hovercraft that you stand on like a surfboard, but it has a propeller powered by electric motor and a battery. And essentially what happens is there you go. See, there you go. You hover above see, this is me filming. I filmed this. This is actual video. There you go. See, you basically hover above the water like that. And what happens is that.
This is in the Hudson?
Yeah. What happens is that because you're above the water, you actually don't get any of the effects of the wake or the waves, and you can actually go and a smooth ride in choppy water anywhere. A lot of people use these things to go across island to island, things like that. Basically, this is a growth area for Brunswick. They think they bought this company called Flightboard. They think it's going to be a $100 million business, if not more, in a not too distant future.
Wow.
Now, you asked me how much it costs.
Yeah, I have
It costs
questions.
around 10 grand, but they want to be able to rent them out in marinas. So,
Okay.
you know, like a jet ski, you rent it out for a couple hours.
So I see two logical use cases there, right?
Right.
A, if you just have a lot of money and you have a lake house, I could totally see buying one of those the same way people buy. The same way people buy, but I'm thinking, I processed the thing about choppy waters. I don't know how much I trust it in super choppy ocean,
We're
right?
skeptical.
But if you have a
You don't
lake
wanna
house,
fall.
a lot of people use jet skis like
Don't
that
fall.
at their nice lake house, right?
Yeah.
You put it on the dock, then you can just go pop over somewhere. You can pop over, get a
That would be
drink, etc.
perfect. That's perfect.
That's like super ideal. And then the rental market.
Yeah.
You go on vacation and they have one of these, and you only have to pay $100, and
You're
you
gonna
get to
get
use
that
it for a certain amount of
immediately,
minutes.
yeah.
You want to check that thing out.
Yeah.
I would totally rent that, 100%.
Yeah. Okay, see, I know myself, and I know that I won't balance as gracefully as the person.
The guy made it look
at.
so easy in the video.
I just know myself.
You know
I'm
what the guy
going to
did
fall
too?
off.
He was sitting on it at one point. He ran like this. He was sitting and used the little joystick and he used his drive around like this. Yeah.
I
he
mean,
was hanging
that's
out.
insane.
Yeah.
As soon as you go, does it fall over though?
Well, it has like a gyroscope that kind of keeps it up, so you don't. It's
Okay.
always balanced. Okay, so anyway,
Yeah.
I guess that's that. But
I mean, I'm not buying. At $10,000, that's ridiculous.
All right, next time we send Pross to the boat show, he's got to try that out for us. So
Yes,
we got to
I
go.
wanna see you in a wetsuit
Maybe it's still
trying it
going
out.
on. We got to
All
get
right,
Pross
all
over there to try it out, but that's going to do it for us over here today, guys. More Yahoo Finance Live on the other side.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard
hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Mester Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Well, mortgage rates have skyrocketed just in the past few months, with the 30-year fixed term now coming in well over 7%, which is a far cry from the 3% we were looking at during the pandemic. The rise has contributed to the housing market stagnation as buyers try to avoid the high rates and sellers try to hang on to their better deals. Our next guest says he may have the solution with his new company, Rome. They list properties that have the option to purchase the home and its current mortgage, locking in low rates known as assumable loans. But does it come with certain conditions? Let's bring in CEO Ronak Singh. He joins us now. Ronak, you got a lot of people talking with that headline of a 3% loan. Talk to me about what exactly an assumable loan is and why people haven't heard about it until now.
It's a great question. So thank you so much for having me here. A large part of what we're here to share is actually that this is a credible way to be able to purchase your next home with a mortgage as low as 2%. So an assumable mortgage is just a type of home loan where you can take over the interest rate that the seller currently has in the home. So for buyers, this allows you to purchase a home with a mortgage as low as 2%, which would be a reduction in monthly payments by more than half compared to purchasing at today's prevailing rates. And for sellers, it helps you find significantly more buyers for your home because your home is the only one in the neighborhood that comes with a mortgage included.
So full disclosure, Josh and I are both in the market right now, and we heard 3%. I've been reading up on this with the assumable loans. As I understand it, it is limited to FHA loans as well as VA loans. Can you speak to how wide this market is? I mean, what percentage of the transactions that are happening in the housing market can assumable loans be applied to right now?
Yeah, so let's think about all of the home loans that were originated in 2020 or 2021. Most of those came with an interest rate below 4%. And actually, most folks don't know this, but about 30 to 33% of those loans were government-backed loans. And all of those loans are eligible for the assumption. So there are literally millions of mortgages out there that can be assumed today.
And Ronak, as Akiko mentioned, my family's looking for a home, and it is tough out there, Ronak. So I might be texting you after this segment for some tips and tricks. One question I had, though, Ronak, was I would assume, and correct me if I'm wrong, my friend, but I would assume a lot of people, maybe even most people, Ronak, they don't even know about this option. Is that true? And if it is, how do you get the word out? How do you educate people about this?
Yeah, so this is actually one of the main challenges that we set out to solve with Rome. So, let's say you were looking in Zillow and you were going to go to, look for a home in Atlanta and use the keyword search function. You would be looking for an assumable mortgage. You might only find a few results, like let's say 5 homes. Now, if you pop over to withrome.com and click on the listings tab, in Atlanta, you will see literally hundreds of homes, like 500 plus. And the reason for this is that we built the first ever feed of homes that were eligible for the assumption. As you mentioned, most folks don't know this is an opportunity, so they don't know to advertise it. They don't know to tell their listing agent to advertise the affordability benefit. So it doesn't end up showing up in a lot of the normal real estate platforms you might go to, which is why we built a product where you can come to first to find the most affordable way to purchase a home at withrome.com.
So talk to me about the terms of these loans. In other words, I am the seller, right? And you are essentially passing on this loan that you have, potentially locked in at 3%, to the buyer. If that buyer doesn't pay down on those mortgage rates, right, mortgage payments, if they miss one, if they miss a few, who's on the hook at that point?
So actually, whenever you transfer a mortgage, so when the loan is assumed by the new buyer, the seller will be released from liability on the loan. They will not be on the hook for any mortgage payment that the subsequent buyer does or does not make.
Well, Ronak, I also wanted to ask you about some of the support you received, including from some pretty big venture firms. Peter Thiel's Founders Fund is one. I'm interested, Ronak, how did that relationship come about, and what have you learned from Founders Fund? What kind of support and assistance have they given you there?
Yeah, so I've loved working with Founders Fund and Eric. Eric and Keith were obviously co-founders of Opendoor, and I was obviously at Opendoor early on in my career. I actually started as a loan officer at Opendoor, which is how I grew to have a real appreciation for their product. And I grew to understand, not only were millions of other people going to be able to be helped, but I was too. Like my own personal story is that I started by looking for homes that were going to be able for me to purchase. And as I kept looking every month, I found that the rates went up and the monthly payments went up right alongside them, which meant that the number of homes I could afford got smaller and smaller and smaller. And so I started looking for a more affordable way to be able to purchase a home, and I actually kind of stumbled on this idea of the assumable mortgage. And as I spoke to folks about it, it seemed like there was a clear win for sellers to be able to help find more buyers for their home, and for buyers to be able to find a significantly more affordable way to purchase. And working with Eric and Keith has been tremendous. They show me a lot about how to build an iconic company, and it's something we're really excited to do here, to be able to bring a massive benefit to consumers and build an enduring business at the same time.
Let's talk more about the strategy for the company. So you essentially make money by taking 1% of the purchase price, correct? I mean, you are in 5 markets right now: Georgia, Arizona, Colorado, Texas, and Florida. How quickly are you looking to expand beyond those markets, and why start there?
Yeah, so we started in these markets because that's where you see most of the assumable mortgages. So we're right now licensed in about half of the country by market share. We're going to be expanding roughly to the other half of the country very shortly. The response from customers has been overwhelmingly positive. And so we're excited to capitalize on that and bring every American the chance to be able to affordably buy a home very soon.
Rome CEO Ronak Singh, certainly interesting conversation to have. We look forward to following the business there. Thanks so much for joining us today.
Thanks so much for having me.
Coming up, it is closing time here at Yahoo Finance. We're going to recap the top stories of the day and get you set up for everything you need to know tomorrow. Stay tuned.
morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
Just got the announcement. What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
It is closing time here on Yahoo Finance. Let's get you caught up on today's top stories. Instacart delivering in its debut. The online grocery retailer stock began trading on Tuesday at $42 a share and closed its inaugural session at $33 a share. The IPO is a long-awaited step for Instacart, which was founded in 2012, and it's the first notable venture-backed company in the U.S. to go public since December 2021. In its speech Tuesday to the United Nations General Assembly, President Joe Biden urged world leaders not to abandon Ukraine in its war with Russia and remain united in supporting them. Biden said, quote, "If we allow Ukraine to be carved up, is the independence of any nation secure?" And the Wall Street Journal is reporting a Justice Department investigation into Tesla's company spending. Citing sources, the Journal says federal prosecutors want to know if company expenditures blurred the lines between business endeavors and personal projects for CEO Elon Musk. SEC rules require that companies report extra financial perks. An earlier report said the DOJ was looking into claims that Tesla commissioned employees to work on and order supplies for a glass house meant for Musk. Now, that inquiry has widened to include the company's representations about Tesla's driving range.
And time now for What to Watch Wednesday. The Federal Reserve is in focus. Fed Chair Jerome Powell to take the podium in a press conference delivering remarks on the latest policy decision. Investors expecting the FOMC to hold interest rates steady amid a cooling labor market and inflation easing. Fed will also release an update on economic forecasts, offering investors around the path of inflation and future monetary policy. And to help digest this all, Yahoo Finance will be speaking with former Atlanta Fed President Dennis Lockhart, so be sure to tune in for all the Fed coverage. And turning to the earnings front, FedEx among the companies set to report its latest quarterly performance. Company set to report its first quarter results after the bell. FedEx saw e-commerce and shipping demand slip in the fourth quarter. But with rival UPS expecting higher expenses and Yellow's bankruptcy, investors will be looking to see if FedEx's luck can turn around.
And that'll do it for today's Yahoo Finance Live. Be sure to come back here tomorrow. We're going to be here at 2 p.m. Eastern to break down that Fed decision. Of course, bring you live coverage of the Fed chair's press conference. We'll see you tomorrow.